All right, going back to this. Seller's net after commission. What my question was, Nashwan, and everybody else, what my question was, is if you knew that our commission was the most powerful thing in a real estate transaction. In fact, nobody in the transaction gets paid until we get paid. Did you know that? We take off the top, whatever's left for the seller. The seller has to pay all his expenses. He has to pay any mortgage, outstanding mortgage. Has to pay other expenses like closing costs, right? But we get paid off the top. We're the first ones. Isn't that cool? We control the whole transaction, guys. Anyway, so we can apply the X bar or the steering wheel formula here. It's the seller's net after commission that we're trying to figure out. And because it's after commission, here's what you need to remember. Just like your paycheck, the seller wanted the $200,000, but unfortunately, there's deductions. How much does the seller get? Whatever it is after deductions. Okay. When I say us, I mean the brokerage. Yeah. Well, but in the brokerage payments, okay, Jefferson, in the brokerage payment, it counts for yours. So technically, nobody gets paid until you confirm your paycheck. Once the broker gets it, you already know you're getting your 70% or 80% or 90% or whatever split you have, right? My point is, first goes what applies to your payments, then everything else. These are the variables, as we said before. Okay, here we go, some examples. After deducting, pay attention to this question. There may or may not be a similar question in the exam, on one of the exams, school or state. After deducting $9,725 in closing costs and 6% broker's commission, the sellers received their original cost of $187,500 plus $18,200 in profit. What was the sales price of the property? The question could be as simple as that. So we have closing costs, $9,725, broker's commission, 6%. How much they paid for it? Original cost, $187,000, and they made $18,000 profit. So how much? That's the question. What was the sales price of the property? We're going to add all these numbers. We have $9,725 closing costs, plus $187,500, plus $18,200 in profit. That's $215,000. Now, here's where most people make a mistake. You ready? This part was easy, right? Because we just need to add everything. If we deducted, now we need to add. Here's where everybody makes a mistake. If 6% was taken, all I got to do is add 6%, correct? No. That's the mistake. We don't add 6%. We need to figure out what this represents right here. What does this represent? It represents what was left after the commission. So 100% sales price minus 6% commission, 94%. So these 215,425 is what was left for the seller to pay the closing costs, his profit, right? And whatever the original cost was, or mortgage if there is one, right? So using the X bar formula, we have a number on top, which is the net after commission. We have a number at the bottom, which is 94%. What do? We divide. Number on top divides by the bottom. Yes, all right, good. Number on top divides by the bottom. So how much is sold for? $229,000. Now I want to challenge you guys to add or multiply by 6%. Figure out if the 215. I just want to make sure you guys see that it doesn't work.
The 215.
Yeah. Because what a lot of people do is we're adding up, then we're going to add plus 6%, right? So do 215, 425 plus 6%.
12,000.
No, that's times. If you do plus 6%. You're adding the 6%.
215,425.
Plus 6%. The answer is 228,350. Is that what it sold for? No. Because it's not plus 6%, we need to always figure out what this number represents. How much was left after? So if this was a pizza pie, right? If I'm hungry too. If this was a pizza pie and we took 6%, right? We need to figure out what was left over, which is the $215,000. What was left over was 94% of it. That equals the 215. What was it? 215,425. If you add 6% of that, it's a different number. You cannot calculate 6% of what was left. You got to always calculate based on the total. Now, if you had the 6% commission value, if you had that value, now you can use 6% as your number to base on. Because we don't have neither the gross sales price nor the actual commission paid out, we can never use 6%. We got to use what's left over, which is 94%. Does that make sense? Okay, any questions? You're good? Milton has a question. Go ahead. Guys, if you have questions, write it down now before we move forward. Closing cost is not part of the profit from the seller. Profits? No. If it already says everything, if it's a cost. Okay, so we have, in this case, the property sold for 229, right? Let's say, minus the 6% commission, which is what we get paid, minus closing costs. No, that's not mortgage. Closing costs is for instance, let's say registering the title, inspections, appraisals, whatever was not paid up front, it will be at the closing. So remember we had, attorney fees. Remember we talked about debits and credits, which we're going to go over later on today. So those are closing costs, right? Recording fees are closing costs. So minus any mortgage, whatever. So whatever's left over goes to the seller. So let's say in this case, whatever was left over was 187. So 205, right? Which is plus the profit, right? So 205. This is what was left over. When I go look at how much I paid for, I paid 187,500. What's left is that $18,000. This is my profit. You know what I'm saying? So we keep on deducting until we reach to how much money I actually made. If there was an outstanding mortgage, we would deduct the mortgage. If there's outstanding liens, we would deduct the liens, and hopefully there's a profit, not a loss. Okay, so closing costs is what it costs to actually close. So again, it's the recording fees, it's the title fees, it's the appraisal fees, whatever fees at closing.
And the seller is usually responsible.
Usually the seller is, although the buyer also has some closing costs, but everything is negotiable. Oh, vice versa, I'm sorry. The buyer is responsible for most closing costs, and then the seller has some. Because all the new recordings are based on the buyer. We're recording a new mortgage, a new deed, a new everything, right? So appraisals are on the buyer's side and so on. So there are some costs that are to the seller, like realty transfer fee, right? You guys remember this? All right. All right, next, how do you determine interest? You guys already know this. This is like a review because we had this in the chapter, in the finance chapter. There's something called LTV. What is LTV? Loan to value ratio. So for you to calculate interest, you need to know how much was financed. How do we know how much was financed? Based on the loan to value ratio. Okay. So this is the formula, sales price times LTV gives us the loan amount, right? Notice that I clarified here sales price or appraised value, whichever is less. That is the formula. And here's an example. A property sold for $415,200. That was a sales price. The lender approved 95% of the loan at 3.5% for 30 years. The appraised value on this parcel was $417,800. How much interest was paid to the lender in the first monthly payment? So let's look at what they're saying. Sold for this much, appraised for this much, 95% loan, 3.5% for 30 years. They're asking, what was the interest paid on the first? Look what I'm putting in red. Monthly. You guys know interest is annual, right? So if they're asking for monthly, at one point we have to do what? Divide by 12. So these are the things to look out for. Pay attention. Okay. You don't know how many times I see this mistake just by not dividing by 12 or multiplying by 12 to get to the value, either annual or monthly, depending on what you're trying to do. So loan amount equals 415,200 times the 95%, which was the LTV, right? That means the loan amount is 394,440. Okay, that's step number one. We want to figure out the annual interest. That's step number two, right? So annual interest is the loan amount times the interest rate, 3.5. Okay. Oh, this was me mistake. Sorry, it's here, right here. So 394 times 3.5%. The annual interest is 13,805.40, right? Yes. Is it annual that we need? No. So we have to divide the annual divided by 12 to reach the first month's interest. Now, guys, this is not the same for 30 years. That's why it's the first month's interest. This is a simplified form. First month's interest. Then the next payment is going to be a little bit less. The next payment is going to be a little bit less, and so on and so forth. Okay. In the state exam, if they ask you a question, is usually the first month, and it's as simple as this. We did it on the financing chapter. We're doing here again. In the financing chapter, we even went a step further to figure out how much went towards the principal and what was the balance of the loan. You guys remember? Okay. All right, next question. How to determine the monthly principal and interest payments. Now, a loan payment factor can be used to calculate the monthly principal and interest payments on a loan. The factor represents the monthly principal and interest payment to amortize $1,000 and is based on the annual interest rate and the term of the loan. The amortization chart is provided in the exam. Do you guys remember the amortization chart? Okay. It's in the finance chapter. And I even showed you how to use it, right? Let me just go to it real quick. right here. All right, you guys remember this? Okay, and if you don't know how to use it, right here it says how to use this chart. You're going to find whatever the interest rate is. You're going to find whatever the year is or the term, let's say 4.5, and you're going to go here for 30 years. Boom. That's the number needed to amortize per thousands. In this case, I'm already giving you that number. Okay. So if a lender uses a loan payment factor of 5.07 per thousand of loan amount, what will be the monthly principal and interest payments? The first thing you got to do, this chart is per thousands. So the first thing you got to do is divide by 1,000. And then you times it by 5.07. You're confirming? Good. Never trust Bruno. So confirm it. You're going to ask if the 200, which number? 200, this one? This one is the loan amount. In the question, oh, hold on, what did I do? My tablet just said, let's get it over with.
You're done.
You're done. Get it done. Okay. What you're saying is I didn't put in the,
Yeah.
my bad. But anyway, if it's a 299 loan amount, I need to add this here. All right, so what you get from the chart is this. It's the 507, because if the loan was 3.5%, 4.5% for 30 years, this will be the number. In this case, like I said, I gave it to you in the question. The loan was 299,180. I just didn't put it in the question. I apologize for that. And that's how you'd follow to calculate. Divided by 1,000. Whatever number comes out of that, you multiply by the 5.07, and this is the monthly principal and interest. Question. Is this what you pay in the mortgage?
No,
There's something missing. TI, taxes and insurance, most likely, right? If you don't pay it together in your loan, you will pay it separate, but you still have taxes and insurance. Very good. All right, the next thing we got is how to solve points. You guys remember what a point is? The point is 1% of the loan amount and never, ever, ever the purchase price. 1% of the loan amount, never the purchase price. Okay. If you guys notice, the formulas are pretty much the same across the board. It's just a matter of understanding what goes in what place. Points are a percentage or an amount or a portion of it. So it goes on top. The percent rate of those points goes at the bottom along with the loan amount. So as an example, a lender will charge 2.5 discount points on the $380,000 loan. What will be the total amount paid as discount points at closing? What we're trying to figure out is the total amount paid in points. The loan is 380,000 times 2.5%. Okay, I'm getting verification from my my panel here. So the answer is 9,500 paid in points. Any questions here? I'm going through every single math example we've had across the book, right? All the chapters. So laying it out here, because visual is always better than just wondering. Any questions? If I told you that was a 10% down payment, what would you have to do?
You would have to.
And 380 is the loan amount, so you're taking 10%.
No, wait, ask the question again. On this person.
If I told you that was a 10% down payment, what would you do?
90%.
Mm-hmm.
But I was gonna guess, I was just gonna subtract.
You can subtract. Try it.
The price is 380,000.
Nope, that's the loan amount. That's where you're making a mistake.
6% down.
10% down.
Right.
See, guys, the 380 is already what's left over, which represents 90% of the purchase. So you got to figure out what the purchase price was. It's not 10%. Nope, you don't multiply 10% from here. You got to figure out what we did before. Look right here with the 90 where is it that I right here. It's the same thing as the commission. You have to figure out with the 94%. In this case, the 90%. 380 is 90%. So if 380 is 90%, what do? 380 is a portion, 90% is the rate. Where does portion or part go? Ooh, you got to know how to use the X bar. All right. I told you there was a 10% down payment. The rest represents 380. So this is 90%, which is the leftover. You're trying to figure out how much is the down payment. Part is always on top. So what goes on top? No, 380.
But isn't that also part?
Yeah, but that you don't know anything about. You don't have neither what the 10% actually represents, nor the gross sales price. That's why it's the leftover. So we got 90%, right? The times would be here, and we're trying to figure out. So part we're going to substitute by 380. And we're trying to figure out, that's the question, what was the sales price? So it's 380,000 divided by 90%. What do we get? We get 400 and are you trained? Two. Okay, we stop right there. All right. So what is the 10%? What is the down payment? Of what?
42,000.
42,000, right? Okay. You guys got it? It's the same steps as the commission. You need to figure out what that 380 represents. The 10% cannot be used on what's left. It has to be used on the total. If we don't know the total, then that's the first thing to figure it out. The down payment was $42,000. So if the question asks you that with 10%, how much they needed to bring at closing? Remember we did this in the finance as well? Now we know I need to add 9,500 to this. So that's the total money we need in at closing. 42 plus 9,500. 42 is for the down payment of 10%. 9,500 is the points towards the loan. That's the total cash we would need. So the answer, if I was asking that, would be 51,722. Yes. 51,722. Yep. Where did I lose you? Yes. She's like, no. Donnie, if we fail math questions, will we fail the whole test? No.
Years ago, I'm just trying to buy the house. The house supposed to be 390,000. Right?
Okay,
How much the down payment?
you're trying to buy a house, it costs you 390,000. How much is the down payment?
I'm saying,
I don't know,
Missing
what,
a number.
what was the percentage rate?
I think it's two.
2.5 was the down payment?
That's a low.
No, I'm sorry.
3.5, 3.5, yeah. So then it would be the sales price times the 3.5%. You have all the formulas right here.
So we have to divide.
So if- You got to go to the LTV ones. Right here. So you have everything here.
Yeah, because they
If-
give me the payment, but it never explained me,
Yeah.
where the risk we have to pay, plus the closing.
See, and that's the part that most realtors fail and most mortgage people fail. Everybody advertises, oh, buy a house, only 3.5% down. No, 3.5%. I mentioned this in the first week, 3.5% plus closing costs. Right now, we can negotiate the closing costs with the seller. In today's market, we can start doing that. But the buyer always got to be ready for closing costs. In fact, you might not get approved for the loan unless you have the reserves for the closing costs. You understand? So we need to be able to go over these things and explain to them. Yeah, it's there's no straightforward, no. All right, if we fail math questions now, you have only up to 8 questions, as I said. How many math questions are there? Again, just answer up to 8. Is that type of ad illegal? Not if you're explaining. That's why we put the asterisks and all that stuff, like, hey, qualified buyers, there might be other fees. Everything has to be disclosed in the ads. That's part of the Truth in Lending Act, or Regulation Z, advertising rules. Yep. Okay. This is why, under the TRID rules, we have to provide a loan estimate, which includes an estimate of closing costs as well, which nobody goes through. They see, the thing is, even though they're enforcing all this stuff, the LE, the loan estimate, and the booklet, your home loan toolkit booklet, must be provided, but nobody's required to explain it. Isn't that crazy? The lender is not required to explain. The loan officer definitely not, because he represents the lender, he or she. And we're not required to do so either. So it's kind of like pretty much, hey, I disclosed, right? Now it's at your own risk. So what's the point of that type of disclosure? What if the person doesn't know how to read those documents? This is why, again, it's so important for us to understand, so we can relay that info to the buyers and sellers. Jefferson says, at the bank, they always just say, read it over, knowing that it's a lot of info. Yep. Yeah, that's what it is. And the thing is, because they provide it to you, and because it's in English, plain English, you cannot go to court and say, well, I didn't know. You should have read it, should have asked questions. There's no law that imposes on them to explain to you. All right, next one. If we're trying to figure out profits. So the formulas are the same. Again, formulas are the same. If a home listed for $438,000 and sold for $415,000, which gave the seller a 12% profit over the seller's cost, what was the seller's cost? If this sale brought 12% to the seller, what was the cost when they purchased the property? Okay, so you have 100% of the seller's cost. That's how much they paid for, plus 12% profit. Whenever there's a profit, this plus goes here. If there's a loss, well, we put a minus. It's as simple as that. 100% of what I paid for, plus 12% profit. So the number we need is this. What is 112% of it, right? Now we know what 112% of it is, which is how much it's sold for. Now we need to revert. Right? Sorry. Yeah. So here it's 112. I forgot to put the 1 in the front. So 112%. 415 divided by 112%. And what do we have? 370,000. Why does it say paid in full? I'm so sorry, guys. There's a few things here. This is profit. This is sales cost. Please correct it. This was seller's cost. Seller's cost. So they sold it for 415, which included 12% profit on it. How much did it cost? 370 when they purchased. Obviously, if they ask you what was the profit, at this point, you would have to 415 minus the 370, and that would tell you what the profit was. Okay. All right. How do we estimate the value from income producing properties? How do we estimate the value from income producing properties? You guys remember that? In appraisals? That's the appraisal chapter.
Yes, subtract expenses.
You have to subtract expenses, operating expenses, and stuff like that. Yes. So when appraising income producing property, an opinion of value can be formed by using the property's annual net operating income, or NOI, and the current market's rate of return or capitalization, cap rate, right? Annual scheduled gross income is adjusted for vacancies and credit losses to arrive at the annual effective gross income. The annual operating expenses are deducted from the annual effective gross income to arrive at the annual NOI. So if you guys remember, when we were, I told you the NOI was the most important number that we needed, right? So we have the PGI, which is projected gross income, expecting 100% occupied, right? Remember that? We have to deduct for vacancies being empty or even losing rents. So if it's 4%, then we deduct 4% of what we expected. And this gives us EGI, which is effective gross income. Once you have EGI, you deduct for annual operating expenses. And we get to the number that we really need, which is the net operating income. You guys remember this or no? Yes? You're saying no? You weren't here for the appraisal chapter, maybe. Okay. NOI is what we need. The formula was NOI divided by value equals cap rate. NOI divided by cap rate equals value, or value times cap rate equals NOI. So these are the variation of the formulas are very similar across the board, as you saw. Okay. So if an apartment building produces 219,000 annual gross income, 219,000 annual gross income, if the annual expenses are 48,300 and the appraiser uses a 7.25% cap rate, what is the estimated value? Okay, so we got, again, the numbers that we need. There's not much calculation going on here. They could have detailed the expenses. They could have detailed a bunch of other stuff. Here's what we need. Annual gross income minus annual expenses we get to the NOI, which is the number we need. NOI. Now that we have the NOI, we also have a cap rate. Okay? And this is the formula. NOI divided by the cap rate equals value. So $170,000 divided by 7.25. This property is worth 2.3 million. If the property brings over $100,000 in this area, let's say the values are 7.25 of it for the cap rate, then it's 2.3 million. Are we good? Okay. Now, if the question said 219,000 with a 5% vacancy or expected vacancy, and then the expenses and so on, then you needed to include the 5% vacancy before getting to the NOI. So PGI minus the vacancy minus expenses, NOI. Okay, you have that on chapter 16.
So to get the, what, 5% vacancy would be, you would just multiply
Hmm?
the total,
No, I'm sorry, go ahead, keep going.
the 219 times 0.05.
So, yeah, well, you would do that, but the trick for the calculator is literally minus 5%. That's a trick. I'm gonna show you real quick. You don't have to multiply anything here. So 219, right? 2.05, that's what you were saying. That's 10,950, but then we have to do 219 minus 10,950, which is 208.50, right? If you would have done 219 minus 5%, 208.50. Okay, so it's one less step. It's just plus or minus the percentage, and it should work. Okay, but yes, you're right. If you were to do it, if you don't know how to do, if you don't remember the plus or minus, which is a lot simpler, you would have to multiply by that, figure out how much it was, deduct from it, and then move on. Plus or minus, it helps. All right, prorations. What are prorations? Shakira says, can you go back to the profit one? I keep on getting a different number. What number are you getting? Here it's 112. If you're looking at your papers or anything, it's 112. I made a mistake. I need to correct that. I mean, I forgot the number there. It's not 12, it's 112. See, I wrote up here 112, but here I corrected it. Yeah. No, that was not your mistake. That was my mistake. I apologize for that. And I'll tell you what, guys. I think every single book publisher should do this. Do a class with a book that they create, because I found so many mistakes in their books, and I send them messages and say, "Hey, there's a mistake." You know what they do? No. In the next version, they do correct it, but they put 2 other mistakes. It's the funniest thing. But this is actually good because it's minor typos. It's not like a big thing, but it could lead to confusion as you guys are going through. So I'm glad that I'm teaching as we go before actually printing this book. So few mistakes. All right, so you guys got it now, right? Let's go to prorations. Okay. When we get to prorations, it says to prorate means to divide proportionally some expenses and income may be prorated for the closing of a real estate transaction. We will look at prorating interest on the loan, ad valorem taxes on the property, and homeowners insurance on the property, and rent on income producing property. All the calculations in this section are carried to the 3 decimal places. I put 2 decimals, I'm sorry. I was gonna do 3, but in the state exam, it's gonna be 2 anyway. So 2 decimal places and rounded to the nearest cent in the final step. Also, we have different calendars used. You guys remember that even Steven messed with me with the leap year? There's different calendars. There's the accounting or banking calendar years. And there's the actual calendar year that we know. So this is how they look. If it's the accounting or bankers or statutory year, across the board, every month is the same, 30 days, right? That means this is the 360-day method. You guys remember? Okay. Then there's a different calendar, which is the one that we on a daily basis use, which is the 365-day method. And this is based on actual number of days in the month, right? This is the one that everybody's familiar with. And then occasionally we have Steven's calendar that includes one more day in February. That is the leap year. So that means we have 360 days for that year. Okay. Now, there's another difference, guys, which is prorating through and to the day of the closing. Every question will say, if you guys don't remember from the closing chapter, every I got a thumbs up from Steven. If you guys remember, every question in the closing chapter said that the person owns to the day or the buyer owns that day. Usually it depends on the closing time. If you're closing in the morning, then that day belongs to the buyer. If they're closing in the evening, then that day belongs to the seller. And it's prorated and adjusted to that day. The state exam and the school exam will tell you exactly the day of belongs to the seller or to the buyer in your calculations. Okay, so again, this is very important when calculating the days owed. Who owes what to whom? Okay, so how do we calculate proration problems? Once the number of days is known, the amount of the expense or income per day must be found. Either the annual amount is divided by total days in the year to get the daily amount, or the monthly amount is divided by the total days in the month to get the daily amount. The correct type of year, so if it's a banker's year, or if it's a calendar year or calendar leap year, must be used when computing the daily amount. The final step is then to multiply the amount per day by the number of days owed in a prorated amount. The difference between debits and credits in a proration problem. You guys already know that a debit is a minus, a credit is a plus, right? You guys remember that? Debit is a minus, credit is a plus. What you need to remember is that when there's a prorated amount that involves both the buyer and the seller, there will always be a double entry. If it's something that relates to the buyer and the seller, there'll always be a double entry. What does that mean? It means that what's taken from one is given to the other. Therefore, you see the same number on both sides. Okay. So it appears one says debit to one party and one says a credit to the other party. Okay. All right. So when you're doing prorations, you got to ask this. What calendar is to be used? No, it's whatever the question asks you. It will tell you if it's the 360 method or if it's the 365 method. So these are questions when you're looking at the actual question in the exam. Which am I using? If it says use the 360 method, every month is 30 days. If it says use the 365 method, then you got to calculate based on the actual days. The other question is the expense paid in arrears or in advance? Meaning at the time of close, was it prepaid or, was it unpaid or prepaid? Okay, so that's right here just as a reference. unpaid, and prepaid at the time of closing. You guys remember this? If it's prepaid, who gets the credit? And who has the debit? Prepaid. The seller gets the credit. Thank you, Milton. If it's something that's prepaid, let's say I prepaid the taxes for the year and we're closing in February. Should the buyer enjoy the whole year tax-free? No. So there has to be a credit or money given to, are you okay, Shakira? Given to the seller. Okay, and we take the money from whom? The buyer. So we need to know who's responsible for paying the expense and who has earned or received that income. You got it? Who is supposed to receive it? Who pays? Who receives it? And when will the expense be paid? All right. Shakira, what's up? You put that smiley face with the twirly eyes like you're dizzy already. What's the question? Prorating is a lot? No. I'll go through the examples right now, so it'll be easy. Ready? So let's go straight into the examples because we already went through the text pretty much. A home was purchased on April 4th. Okay, so we got to know this. These are details. So if we're going for prorations, April 4th. It was purchased for 110 and the closing was set for the following May 8th. The buyer assumed the seller's loan balance with an original loan amount of $96,000 at 6.5% interest and monthly payments of $612.62. How much will the interest proration be using the banker's year and prorating through the day of the closing? You see how the question says we use the banker's year? The state exam will say the 360 method. Okay. Prorating through the day of the closing. Who will be debited and who will be credited? So these are the steps. Step number one, we need to find the exact number of days of earned or accrued interest. You need to remember that interest is based on 30 days. Right? Interest is based on 30 days. You can have a 30-year interest, but that's assuming you're going to use all 30 years, right? We're paying before that. So there's the closing is in May 8th, right? How many days do we have in May? 31. Yeah, I don't know. I gave you a table. You're going through the knuckles? You're going through the knuckles? All right, knuckles, right here.
It's a banker, 30.
And that's the thing. If it's the bankers, use just 30. You'd be correct if we're using the calendar year. Very good. Got it? All right. Because they told you the banker's year or the 360-day method, every single month is 30. So it does not matter if it's what do you call it? It does not matter if it's 31 days or if it's 30. Here we use 30 no matter what. So let's go back down. And it says the seller owes May through May 8th. So we said that they owe through, prorating through. That means the seller has that day. Okay. If it said prorates to the day of the closing, then it will be 7 days because the day of closing belongs to the buyer. Step number two, we found out the days. Now we need to find the daily interest charge. So we need to find out the outstanding loan balance times the annual interest rate, which gives us the annual interest. And then we divide by 360. Why by 360?
Because of how many days are in the bankers.
Because it's the bankers or the accounting or 360-day method. Very good. All right. So the question said 93,600 with 6.5% interest rate. So the annual interest is 6,084. We divide that by 360 to get a daily interest of $16.90. Okay. Now, I told you the interest is on a monthly basis, right? How many days do we have in the month of May? What is it? How many days do you have in the month of May?
The baker's calendar?
What calculations are we using?
Bankers.
Bankers.
So 30.
Guys, you got to remember that. We just went through it. It's the bankers. So 30 days, right? But it doesn't matter. We have 8 days in this closing. So that's the number we need to use. $16 times 8 days. So we're going to take 135 from the seller, and we're going to give 135 to the buyer. All right. I got to go through this, but I'm going to give you the same trick I gave you the other day. All you got to remember, it's the same amount to both. And then remember who gets the credit, who gets the debit. Shakira, I just gave you the answer. So simple. Remember who gets the credit, who gets the debit, and then look for the same amount. I still have to teach you how to do it. All right. But in the state exam, just look for the answer that has exactly the same amount on one side and the other. And remember who gets the credit, who gets the debit. In this case, it's interest. Interest is unpaid because it's unused, unless you use the whole month, right? Therefore, unpaid. The debit is money taken from the seller because the buyer is going to pay for it. It's credited to the buyer. If it was a 365, then yes, you would have to know the exact number of days in each month, right? All right. Then the next examples are hard to prorate taxes. The concept is exactly the same. So I'm going to leave it to you guys to go through it. Okay. Concept is exactly the same. Go through it. At the end of the day, it's always this. Same amount taken from one, given to the other. That's the hint I can give you. Same amount taken from one, given to the other. Yep. Again, yeah. Again, look at this one. Rent proration. It's a debit to the seller, credit to the buyer in this case. You guys understand? So at the end of the day, all of these that we went through follow the same concepts. It's just a bunch of different examples of the same concepts, same formulas, right? Once you nail the formulas, or the X bar, for instance, or the whatever, the steering wheel, for instance, once you nail it, this will be easy. As long as you read the question properly, you should be good. Let me just show you. Okay. So this is the cheat sheet that I have in the math chapter. Whether you use the X bar or you use this is the same. Again, here's a top bar and then the X, it's the same thing. Okay, so the concept is the same. Here you have what you need to remember for the state exam. 100% equals 1, 50% equals half, 150 equals 1.5, 12 inches is 1 foot, 3 feet is 1 yard, 1 square yard is 9 square feet. I have this here, it's not actually needed. 1 mile is 5,280 feet. 1 acre is 43,560 feet, square feet. 1 section is 1 square mile or 640 acres. Okay. So these are the only things that you actually need to remember, Shanice. You're like, oh, too much stuff. And then the PBR steering wheel or X bar formula or method, whatever is easiest for you. They are exactly the same. Whatever is easiest for you to remember a steering wheel and what goes there, or to just go through the X bar. This is the same: part, portion, or income, base value or whole, rate, percentage, or interest. And then here on the right hand side, you have area, right? There you have width times length equals area. Area divided by width equals length. Area divided by length equals width. So all the variations. Another thing to remember, if you look at it, area always divides by the outside number. It's always a division. So much like the X bar, right, or the steering wheel, always a division. If they're outside numbers, you always multiply them. That's why it's so important to draw, Fernando. That's why it's always so important to draw the area that you're trying to figure out. Okay? If this was an irregular shape, you need to figure out a triangle as well. What's inside, what's outside, very important. Here you see a triangle closed is a box, right? So square. Even though the formula is height times base divided by 2, or base times height divided by 2, I always told you to do width times length. Because if you close it, it's a square, so it's the same formula as on top. But because it's half, this is not there, it's half of it, you just divide by 2. All right? Any questions?